Welcome to the Daily Update. This is Being Prepared Thursday, September 29th, where we'll look at the action in the market today and then see how things look for Friday, September 30th. And I guess we can say that Wednesday's advance was a dead cat bounce. That's the negative side. We pretty much gave back everything that we gained and then some. On the positive side, we're still building what could be a level of support. We're back down to showing a lot of oversold conditions currently. We see fear getting pretty extreme. It seems like all the news in the world right now is bad, unless you're a Seattle Mariners fan like I am. And we just don't really see an opportunity for things to go higher, which a lot of times that's when it ends up happening. Now, it could go lower still, and the headwinds are still pretty strong against the markets. And it just seems like it's bad news after bad news. We are going to get a major report on Friday concerning inflation. So that might have an influence on things, especially if the report is weaker than expected. We don't know if that'll build that scenario again, that maybe inflation has topped and the Fed will start to become more dovish. But the market will probably try to do that. We may get some relief, or if the news is bad, we might end up breaking through this support, this base that we've been building, and then head even lower. All right, let's go back and talk about what happened. Right at the open, we had a gap lower, and there's a lot of bad things going on in the UK right now. There's some real instability in their banking system, which is feeding through into their interest rates and their currency, the British pound. There's a lot of problems happening right now there. That's feeding over into the EU, which is also feeding into the US markets, and just kind of really adding to a already pretty negative situation. But we gapped down below S1 at 36.61. We went down to the previous support level right around 36.25, just in that general area. Prices attempted to recover, but we almost got to S1, not quite. And that was about as much of a bounce as we saw. As the day went on, prices fell down and set a new support level. Now we're still building kind of a base, but we did drop down a little bit, and I'll show you that on the charts. Going into the close, we did see some more late day buying. Now it wasn't massive, didn't turn things positive, but we're still seeing that general pattern of early weakness, late day strength. Is that the smart money coming in to position themselves to take things higher? Now we're getting through this really difficult time seasonally, and what could happen from here tends to be positive, but it could also be negative too. Some of the biggest stock market crashes in history have happened in October. Some of the best times we've seen in the stock market have also happened in October. So we don't really know. We just have to take it day by day. We ended up being down 2.11% on above average volume. We are negative, but oversold with the technicals. We're still freaked out about inflation and interest rates, not only in the US, but in other countries as well. I've added the UK to our geopolitical concerns along with Russia. There's a lot of different things going on in both of those places right now that can have an impact on stock prices. And then any more Fed speak. We did get a little bit more, and the markets didn't really like that, but it's just a reiteration of what we've already been hearing. So it looks like Wednesday was a DCB, dead cat bounce, at least right now. Then we had the Cleveland Fed President Mester, who is a voter, said that the Fed is not yet in restrictive territory with its policy rates. Well, we kind of already knew that. This is just a continuation of what we've already been hearing. So to say that the market's jetted lower based on what he said would not necessarily be a realistic look at things. Plus, it's what Chairperson Powell says. That's the most important thing. The UK is really having a lot of instability right now, and it's causing a lot of volatility in their gilts, which are their bonds, as well as the British pound. And then Putin is expected to come out on Friday and say, we have now annexed 4 of the Ukrainian territories that we've been attacking. And that, of course, is negative for Ukraine. That could add to some instability within the region. I don't know what the U.S. response will be to that. It could escalate things, or Putin is probably just feeling the waters now to say, okay, this is what I'm going to do. Kind of like when Hitler went into Czechoslovakia and then Austria, and the other countries didn't do anything. So then he went a little further, a little further, a little further. Is this just the beginning of little bit furthers for Putin right now? All of the sectors ended up declining. We have the same yield curves that have been inverted, continue to be inverted, the 30 to the 5, the 10 to the 2, and the 10 to the 5. Sentiment is really fearful still. With the down day, we dropped a little bit more down to extreme fear. We had jobless claims, and this is one of the things that is kind of, it's good on one hand because you don't want to see a lot of people unemployed, but it's also justifying why some people are saying we're not in a recession, where it's giving justification to the Fed to keep a real more hawkish stance with interest rates and policy right now, because the employment situation is still looking pretty good. They expected 213,000 people to file for jobless claims. It came in way below that at 193,000. And we had the second quarter GDP. This is pretty much a non-event. We're coming up to the end of the quarter. We already had some previous GDP announcements that were made. There was no change in this report, so it really wasn't all that big of a deal. We came in at 9% with the deflator, where they expected it at 8.9. Okay. And the prior reading was 8.9 on that as well. But so this was not, even though it's GDP, it's not a real market mover. Our trend is still negative and above 20. And I should have changed this. Our bias is now negative. This is from yesterday's chart too, or slide. But we are back to negative, and our momentum continues to be negative. So let's go back and look at sentiment. We dipped down now. We're at 16. So we're getting pretty fearful currently. We're dropping down into this extreme area, but we could still go lower than this. Here's some Isabel net charts. This just is talking about global semi stocks breaking down. These are semiconductors, and this is a large part of tech. And this is what I talk about in the intermarket analysis video that I post on the weekends. It just shows how we've been really coming down and breaking through different moving average. Here's the 3-year moving average, and then we could possibly come down to the 6-year moving average. That would produce another 20% drop from where we're at. And this could really create a lot more problems, especially in tech, which then feeds over into our growth scenario. They're also showing how most people are tending to get into less risky or they have a less risky appetite right now. So when they're below this line, they're seeking more safe type investments. Here's the most recent reading of the RIDEX bear bull ratio. It continues to spike up as people are getting more fearful, and we're starting to get rather extreme. We could still go higher, but at other times, this has also been an extreme reading. This is what seasonality that I was talking about just a moment ago, how it's starting to turn more positive as we're going into October. And we can see over here on the right-hand side, since 1950, the past 20 years, the past 10 years, then when we have midterms, we tend to have positive Octobers during that time. Doesn't mean we'll have one now, but statistically, they tend to be better now. So we might be coming into a more positive time of year. This is looking at the largest calendar year peak to trough. That means bottom, trough. In S&P drawdown, we're down 24% year to date. Mine's a little bit more than that because I go back to the all-time high, which was set at the beginning of 2022. But this is something that we go over all the time. But here you can just look at it with relation to other interesting times that we've had. This is the valuation. Even though it's low, it could still go lower. They like to call things a trough rather than a bottom. So this kind of gray line, this is the US, where it's been coming down. Europe, which is really having a lot of problems. And then the light blue line over here is the rest of the, is that, yeah, the UK. It's really hard to see that. Here's the United Kingdom down here. And we're just seeing things weakening on a valuation basis globally, not just in the US. This is another way of looking at the the active asset managers report that I come out with each week. This is just showing that they have a tendency to do what normal human beings do and freak out when everybody else is freaking out. They tend to sell at bottoms. And that's why we watch this every week, because they have a tendency to overreact both to the upside and to the downside. In this chart, you can go back, and when it's showing extreme readings, this often marks some kind of a bottom in the market. Then we have the surprise index, and this is basically because we've been coming up a little bit here. The U.S. Economic Surprise Index has been bouncing up, and here's the 60-day change in the 10-year yield. Okay, you can go back 30 days, 60. Remember, you can take numbers and manipulate them around to have them say whatever you want them to say to justify a stance. That's I still find these things interesting to look at, but not necessarily to become real dogmatic about them. But as the surprises have been coming up, so have the yields at the same time. This is just showing the number of IPOs. These are new stocks going from being private companies to now being publicly traded. And would you want to take your company public right now? Well, not a lot of companies do. We've just had 32 in 2022. You want a good, solid stock market when you do that, because people get all rah-rah about it. They're willing to pump up your price a lot more. And these IPOs make a lot more money. Well, since 2022 has been so challenging, not a lot of new companies have really wanted to go public now. Then this is liquidation of the world's most crowded trades. This just, again, just shows things are going down right here. And are we getting to some kind of a bottom? We had the bottom during the lockdowns. We had the loan crisis. Then we had when China devalued their currency. Are we going to hit a bottom here at some point and get some support and go back up? This is just showing how gold has not been doing very well at all. And this is also a chart that we look at each day. So going back and looking at the session, we had growth really down 2.56%, but with the mid caps and the small caps, growth actually did a little bit better. The VIX spiked up a little bit on a closing basis, and our bar went back up with the bar chart here because of the down day. And we're still seeing not as much, but a little bit of an increase in volatility with the VIX of the VIX. We're not up to this extreme positive reading. I was going to take this chart out because I thought maybe there was a chance we would keep going up. Well, we want to keep an eye on this in case the VIX gets to an extreme reading with the RSI. The Ultra Index, and this is a longer term chart, and I have a shorter term chart that I usually show. I just wanted to show that where we're at now is quite often we've spiked at lower levels than this. Now here's the COVID spike down here. So this is also suggesting that fear is getting pretty extreme, at least historically. We're down 24.45% since the all-time high. We did see a punch back up with the equity put call ratio, and our 5 period continues to go higher, and it's spiking now in the longer term chart. Here are the support levels and resistance levels for Friday's session. Here's the daily chart showing that we dropped down below the support level, and we're just a teeny tiny bit above it right now. Can we build a base right here and then get some strength up out of that, or are we going to end up falling down below? It's where we close that is the most important. If we close down below this level, that's going to change a lot of things, even though we did set an intraday 52-week low. And this is not positive by any means. See how we have a bunch of prices all forming this base right now. And then at the bottom, we see where volume is above average. Here are the pivot levels. These will change once we get into October. So that'll readjust. And then here's the intermediate term fib chart, just showing how we're just right above this full retracement level. Currently, we're kind of in no man's land with this chart. We're looking at this in case we do break down. We're looking at the 50% retracement level at about 35.09 or 35.10. And then this is another area that could possibly act as support if we continue to fall. We have a very long-term moving average. And then if we do break below that, then we have another 52% or 50% retracement level at about 35.07. And this is a weekly chart of the S&P 500. So it's pretty long term. We're still a little bit down below the midpoint of the trend channel. Looking at the sectors, we were negative across the board. The one that did the best was energy, and they were unchanged, but everything else got hit. Scooter scores, energy improved a little bit, so it's back up into the 90s, and communication is still down in single digits. Here's just a quick look at the sectors. We now have utilities going down from the all-time high set in the S&P. And here's the updated percentage changes of the other indexes compared to the S&P 500. Technical alerts, they were all negative, with the NASDAQ going below 11,000, then 10.9, then 10.8, then 10.7, getting ready for blast off here. We have a BPI cross in the cyclicals. We just had a positive one generated yesterday. Well, with the decline, it switched back and dropped below 20, so now that's negative. Real estate's really having a hard time. The S&P hit a new 52-week low. Utilities are crossing below 30 with the BPI. That might give some support to the S&P because we're seeing a little bit of an improvement in that chart that I'll show you. The Dow is now holding up the best at 57, and that's nothing to brag about, followed by the mid caps at 50.7. The S&P's in third place at 44.8, with small caps unchanged at 43.3. And then the Qs are in last place and really suffered some weakness. Intraday here, we just gapped down. We just shot below S1. We never did get down to S2. That would be near the bottom here. That's because Wednesday's session was so big that the pivot levels were pretty far apart from each other. It looked like we were going to get some kind of a bounce back up. We almost made it up to S1. And then this is when the real selling came into the market. This is when the new low was set intraday. But see, we had some late day buying, which did push prices up a little bit. Wasn't an up day, didn't repair a lot of damage, but we're still seeing this same general pattern of late day strength. Our trend is negative and getting stronger with the red line on top. And our rune is actually turning down a little bit, and it's still pretty extreme negative currently. Looking at breadth, where we saw a really solid, powerful up move in Wednesday's session, well, we saw just as powerful a move to the downside in Thursday's session. So we're declining based on price and volume. Our advanced decline ratio is still pretty extreme negative. Currently, new highs, new lows continues to be weak. Accumulation distribution bounced back a little bit, only to turn back down in Thursday's session. Short term, we're getting back into this oversold condition again, where we were extreme negative, then we had an extreme positive day. Now we're back to extreme negative. We kind of overdid it with the advanced decline ratio. Going over just back one day with the rate of change where we almost went extreme positive. Well, now we're down to extreme negative. Going back 10 days, we're still extreme negative and declining slightly. Stochc RSI is now extreme negative, as is the Williams percentar. The force index, it's not extreme necessarily, but it's still decidedly negative. We're trying to show some recovery from the Swinland trading oscillator based on price and volume, but we're still extreme negative. McClellan oscillator turned back down with the decline, extreme negative. Still extreme negative with our 20, 50, and 200-day moving average study. All of our stochastics are still extreme negative. Now, looking at the intermediate term, we showed a little bit of an improvement with our 19-day exponential moving average of the advanced decline line. This is a little longer term, but it showed some weakness after Thursday's session. but this is still a pretty extreme negative reading, and sometimes this can give some support to the S&P. Standard deviation, we're still kind of far away, but we are declining as we're building this base of prices. The rate of change 20 is now back to extreme. Sean trend meter coming up a little bit, but is still extreme negative. The PPO is negative. PPO or a PMO studies, extreme negative with the rising PMOs, extreme negative with the buy signals, as well as those that are above zero. Chaikin oscillator was pretty much flat. Chaikin money flow showed a little bit of an improvement. Volume is still tending to be above average. That's when we're above this middle blue line here. The vortex is still negative and turning more negative. The summation index based on price is declining, and we're getting down to kind of an extreme reading. We're already extreme based on volume. All of our oscillators are currently going down. The BPI, after showing a bit of a bounce in Wednesday, came right back down in Thursday's session. That's also extreme negative. The ease of movement also is negative. Ultimate oscillator declining, starting to get extreme negative with the money flow index. And we don't get a lot of these readings. This is as low as it's been in about a year. So that might give some support, but first we have to turn up before that can happen. The CCI 14 is still right on the verge of extreme negative, and the CCI 20 continues to be extreme. Our RSIs, after looking a little bit better, could now be turning back down again. The boom indicator also is extreme negative comparing to the 50-period moving average, and still pretty decidedly negative when you compare it to the 200-day moving average. Dow theory still didn't set a new low with the Dow or the transports. We are seeing some now weakness with the utilities. It looks like they're trying to catch up to the downside. TTM squeeze is still negative overall. Balance of power continues to decline. And this, I'm not quite sure what to make of this. This would technically be a buy signal here because we're crossing above this red line as the CMB composite index continues to advance. Be a little leery of that, though. We want to see some confirmation. If you're a little more conservative with this, you might want to wait and see if we're able to cross above the green line as well. But that could potentially be positive. But on a trend basis, we're still going lower with the Heikin Ashi, with the Kegi chart, with the Renko chart, 3-line break. No new zeros with the point and figure chart, but we still have a triple bottom breakdown. The Elder continues to be neutral with the S&P and the SPY. We're still negative with the SAR. We're still in deep purple land with the go, no-go system. Longer term, getting extreme with our 50, 150, and 200-day moving average studies. Getting down to where we were at the COVID low with our rate of change going back 200 periods. Special K continues to decline. The diamonds are still in neutral land, and we're still below this pivot point right now, but it's also potentially building what could be a base. We are negative with the Qs with the decline after being neutral, and we're down below this pivot level as well. We want to watch the NASDAQ and the NASDAQ 100 if prices start to go higher. Actually, we watch them anyway, even if prices go lower, because they are tending to lead the way right now. With the Vixen, we saw a bit of a spike back up because of the decline. The NASDAQ is now below this pivot level currently. So first we want to see if we can get back above that, which would mean we need to exceed yesterday's open. The mid caps also might be forming some kind of a base, but are still looking negative overall. The Wilshire also dropped down a little bit, could be building a base. So we have to ask ourselves, are we building a base here, or is this just a plateau? Are we just resting here before we get ready to see the bottom just fall out of the market? We don't really know that at this point. You can make a case for either side. We're seeing some things in our charts that could suggest things could turn back positive. Seasonality, we're seeing late day strength. Our sector rotation, although it's not positive, has still been holding up. We're not seeing a lot of negative divergences there. But with all these headwinds hitting the markets right now, it's hard to really be positive. Now, let's look at the broad market. The dollar was down about 0.25%. Now, that's another interesting thing. Stocks were down and the dollar was down in Thursday's session. Here's the British pound, after just tumbling, is still making an effort to rebound. Here's the S&P against the dollar, still having a real strong tendency to go in opposite directions, even though it ticked up slightly since they were both down Thursday. Gold was down slightly, virtually unchanged, still in a downtrend. Silver was down almost 0.5%, still in a downtrend. Oil was down over 1% to 81.23. The correlation between the S&P and oil is still pretty strong, even though it curled over a little bit. And intermarket analysis shows that oil is still back in the lead, followed by the dollar. And then you have gold, stocks, and bonds all negative. Bonds they were showing some strength in Wednesday's session. Well, we're down 0.5% in Thursday's session. We continue to show some pretty significant weakness with the world bond index. The 10-year yield, after spiking up, has come down slightly, but it is breaking out. The 30-year is coming back down to the 3.71 level. And then the correlation between stocks and bonds, still, they have a tendency to go in the same direction. The same yield curves here with the 10 to the 5, the 10 to the 2, the 30 to the 5. We have not gone inverted with the 10 to the 3 month. The correlation between the tech sector and the 10-year still having a tendency to go in opposite directions. After really coming down in Wednesday's session with interest rates, they really turned back up. And there's not a huge up, but they did go back up. Our scenarios, just to update this, looks like we might be building a base with our S&P stocks that are above their 200-day simple moving average. We're still at a base point with our 50-period moving average study with the S&P, the mid caps, and the small caps. With the 10-day average of the highs minus the lows, we're still pretty extreme negative. And then when we look at this over 5 periods, we're also seeing extreme weakness across the board. Here's the equity put call ratio really starting to spike, and that sometimes can give some support to the market. Small cap index was down over 2%. Could this be building some kind of a base, or is this a plateau? The small caps ticked up slightly and outperformed the S&P, but it's not really giving any support to these charts currently. What we're looking for is this red chart to spike up, and then usually the blue, which is the S&P, that will start to spike up as well. We're just not seeing that yet. And the S&P to the 10-year also going in opposite directions. Here's our sector rotation. Saw some weakness with the Qs, discretionary, and large cap growth against large cap value. So even though they're turning down, see where the mid caps and the small caps, they're actually doing a little bit better right now. Can that feed over into the large caps? The S&P to the 2-year also going in opposite directions, and we're still spiking up. We don't know if this is an actual spike yet or not. The S&P utilities ratio, see how this is bouncing up a little bit? That could potentially be positive, but we need to see follow through with price. The staples were down another 1.65%. And so this is coming back down slightly, but we still have 3 spikes, not very far apart from each other. And it wouldn't take all that much for a new spike to be created here with the S&P to the staples ratio. So what's our outlook? We're negative and we're back to being oversold again. It's the last dating trade. Okay, let me start that again. It's the last trading day, not only for the week, the month, and for the quarter. So there could be some real jockeying going around in Friday's session. We have personal income and spending coming out. That's a biggie. And this is the biggie too. PCE prices and core prices. This is the other major inflation reading that the Fed really likes to use. And this will give us some insight about the current state of inflation. We have the Chicago PMI coming out. We have final consumer sentiment coming out. We got that 2 weeks ago. And then we had got the whole list of geopolitical events with the whole Russia-Ukraine situation, the UK volatility that's going on right now. Haven't really heard much. Of course, I haven't really looked all that much either for any of the Nord Stream pipeline situation and what the fallout from that might be. But there's just a lot of really negative things happening right now. So our scenarios, we have to go with the down one, but we're oversold. We can't really go with the up one because nothing is pointing up. We're seeing some possible positive things. And unless you're a real risk taker, you might like what you're seeing, but I like to wait to see confirmation with price. Sideways, unless you want to set some kind of credit spreads way above or below where we're at, it's hard to really do any sideways based strategies currently. So our conclusion, the S&P is negative, but oversold in the short term, oversold in the intermediate term, and pockets of being oversold in the long term. So thank you. I hope you have a great Friday, and I'll prepare the next video for Monday's session over the weekend, and I'll also be doing the weekly video as well as the intermarket analysis video.